Hello, my dear students. Let's continue with chapter number 5, risk models. Okay, now tell me, we are into which subject? Risk management. And which chapter? Risk models. So, what have we learned in this chapter? We have learned how to quantify risk using risk measures. Okay, now when we speak of risk measures are used at two levels. One, risk measures are used at business unit levels. And these risk measures are also used by CEOs, CROs, and regulators. Okay, now the use of risk measures is different for both the levels of departments. Now tell me, for business unit levels, say for example traders. Okay, traders do what? Traders invest in stocks. Okay, then they invest in, say for example, options. They invest in bonds. Right now, whenever trader invests in these different items, what do? They try to quantify risk कि हमने कितना risk लिया है, is it within the risk appetite or no, right? So what are the measures that are used? For stocks we may use, for example, say beta. Okay, for options we may use, say, rho, gamma, etc. Right, there are various risk measures that can be used. For bonds say we are using duration. Okay, so these are the various risk measures that are used by traders at the business unit levels. Okay, and what is the case? What are the risk measures used by the CEO, CRO, regulators? Now they need to measure risk at an aggregate point of view, at an entire enterprise point of view, at an holistic approach. So when they calculate risk, when they use risk measures, they consider two things. Okay, what can be the losses? What can be the losses under normal circumstances? And what can be the losses under abnormal circumstances? Okay, what can be the losses under normal circumstances means how bad can the things be? Okay, and abnormal situations means if things turn bad, to what extent they can go to harm the organization. Okay, so when we speak of calculating risk, understanding the losses under normal situations, which technique is used? We used VAR. Which technique is used? We used VAR. Then in case of abnormal situations, we do stress testing, or we may employ scenario analysis, or we may also employ expected shortfall methods. So these are the various risk measures which can be used at the different levels. Okay, so which are the risk measures at business unit levels and at aggregate level? Okay, so business users level, they calculate it at every type of investment that they do. Say for example for a trader. Okay, and CEOs, CROs, regulators. Okay, they calculate this, use the risk measures to calculate risk at an aggregate level. Okay, so they make use of VAR, they make use of expected shortfall, etc. Okay, so this is about risk measures. Now, what have we seen in this chapter? We have seen till now, not just in this chapter, but till now, what have we studied in risk management? That we need to identify risk. After identifying risk, what do we have to do? We have to apply risk measures. After applying risk measures, we have to do what? We have to quantify the risk. Okay, we have to identify our organization has been exposed to how much risk. We have to quantify risk. Okay, and then we can identify in the quantitative manner, in the numerical terms, as to how much risk our organization is exposed to. Okay, now when we make this calculation of risk, we have certain expectations from this risk. We expect that some attributes, some measures must be present while this risk is calculated. Okay, and risk calculation depends on the risk measures that have been employed, because what do? Identify risk, apply risk measures, okay, then quantify risk. So the risk that is quantified depends on the risk measure that is used. Right, so if you want certain qualities to be present in that particular risk, you need to have those qualities in the particular risk measure. Do you understand? So if you want certain attributes, okay, certain properties in that particular quantified risk, then you need to make a proper selection of the risk measure while quantifying risk. Okay, now every risk measure, yes, every risk measure is said to be a coherent risk measure. See, now what does risk depend upon? Risk depends upon the risk measures, right? Now, what is our expectation from the risk? What is our expectation from the risk? That a risk should be what? It should be coherent. What is the meaning of the word coherent? It should be logical. It should be easily understandable. So for this risk that is calculated to be coherent, the risk measure should be what? Coherent. Okay, and a risk measure is said to be coherent if it has four properties. Which are these properties? Subadditivity. What is expected from it? Subadditivity. Then what is the next property? Monotonicity. Then what is expected? Homogeneity. And then risk-free condition. When these four attributes, when these four properties are present in a particular risk measure, then that risk measure is said to be a coherent risk measure. Logical, understandable. Okay, it is clear. Coherent means clear. Okay, so these four attributes makes a risk measure coherent. Okay, yes, so now let us understand each of these in detail. Okay, yes, let's go ahead. Coherent risk measures. We want risk measures to correctly reflect diversification effects and should facilitate effective decision making. So a risk measure should reflect what? Diversification. Okay, now we'll understand what is the importance of diversification as we go through the properties. Okay, the answer to this will be found in the theory of coherent risk measures. If X and Y are the future values of two risky positions. Okay, so we are considering how many risky positions here? Two, X and Y. A risk measure, rho. So now what risk measure has been used to calculate the risk involved here in X and Y? We are calculating it using rho. Okay. So, if X and Y are the future values of two risky positions, a risk measure rho is said to be coherent. So, we are assessing the qualities, the properties of which risk factor? Rho. Okay, if it satisfies the following properties. Okay, the first property that we are going to deal with is subadditivity. Okay, now what does subadditivity say? Let us understand that first. Say, how many risky positions you are considering? Two. So say stock and risk involved. Okay? Okay. So you are considering investing in either X or you are considering investing in either Y. Okay? An investor. Now an investor is deciding as to invest in X or to invest in Y. Now, Mr. Investor, understand that if you invest only in X, what if the entire investment goes to the negative value? What if you invest the entire amount in Y, 100% amount in Y? Then what happens? There is 100% of risk involved in case of Y, right? So here, when you invest in just in stock X, there is risk involved. Risk measure here is rho. This is written like this. So rho of X. If you decide to invest only in Y, then the risk involved is rho of Y. Right? So now what do you decide? You decide that suppose, for example, if losses are incurred in X, then those losses can be compensated by gains in Y, right? Or vice versa. So what you have decided? As an investor, you have decided to invest in X plus Y. So this becomes your portfolio, right? You are deciding to invest in X as well as Y. So now, what is the risk involved? Risk involved is rho of X plus Y. Now understand what is the situation. Say, okay, now what does subadditivity property say? The subadditivity property says that if you would have invested only in X or if you would have invested only in Y, then the risks would have been more than that you have invested in a diversified portfolio. Investing in X and Y is nothing but a It is nothing but employing diversification, right? So what does it say? That individual components of the portfolio, okay, which are the individual components here? X and Y. What are the risks involved here? Row of X and row of Y. What does it say? That if you would have invested either in X or in Y, and as against you have invested in a portfolio, diversified portfolio of X plus Y, the risk of this diversified portfolio will always be less than or to the maximum equal to the individual components involved in that particular portfolio. So what does subadditivity property say? Subadditivity property says that the risk involved in the portfolio is always less than or to the maximum equal to the risk involved in the individual components of the portfolio. Now let us understand this with the help of an example. Okay, see, we have stocks, two stocks here. Okay, which are they? X, Y. Now let us consider what is the return. Say return is 4% from X and 8% from Y. Okay, now how much is the standard deviation? Say standard deviation is 30% and 30%. How much is R? R says 0.5. Okay, and what is the weightage of X is to Y in the portfolio? Say 50 is to 50. Now if I have to calculate the standard deviation of the portfolio, what would I do? What's the formula? Come on everyone, recall your SFM. What is the formula? WX square into standard deviation X square plus weight of Y square plus standard deviation of Y square plus 2 into WX into WY into standard deviation of X into standard deviation of Y into R. Now come on. Quickly calculate the standard deviation of the portfolio and tell me what is the standard deviation of the portfolio here. Quickly. Come on. Are you done? You are a CA final student. You should not take so much of time. Okay, so tell me, is the standard deviation of the portfolio 25.98%? Tell me, is it 25.98%? Is it 25.98%? Yes. Now, let's go to the previous slide. Now, what is said here? What is the portfolio? Come on, tell me, what is the risk involved? What is the standard deviation of the portfolio? It is 25.98%. As against, अगर सिर्फ X में invest किया होता, तो कितना risk होता? 30%. Because standard deviation of X is 30%. अगर सिर्फ Y में invest किया होता, तो कितना risk होता? 30%. Because standard deviation of Y is again 30%. As against, what is the standard deviation? Risk involved in the portfolio is 25.98%. Okay, say if R is equal to 1. Okay, now again, recall your knowledge of SFM. What does it say? That if R is equal to 1, that the risk of the portfolio, the standard deviation of the portfolio is nothing but the weighted average of the risks of the securities. So here, so what is the weight of X? 0.5. Okay. What is its standard deviation? 30. Now in case of Y, come on, tell me, what is the weight? 0.5. And what is its standard deviation here? 30. Right? So what is the standard deviation of the portfolio? How much is the maximum risk that is involved? 30%. Why maximum? Can R ever be more than 1? No. So if R being equal to 1 is the maximum value of R here. So what is the maximum standard deviation of the portfolio? Is nothing but 30%. So in extreme situations, what can be the maximum standard deviation of the portfolio, risk involved in the portfolio? 30%. So just visualize, just see what is written here. What does it say? That when you invest in a portfolio, when you diversify your investment, okay, at the time of investment, if you diversify, in that case, wow, how much is the risk involved? The risk involved is 25.98% or to the maximum 30%. As against, if you invest only in X, 30% is the risk involved. Only in Y, 30% is the risk involved. Understanding that means that the risk involved in a portfolio is always less than 25.98, 30. Always less than or equal to the maximum. If R is equal to 1, how much will be the standard deviation of the portfolio? 30%. Maximum, it can be equal to the risks involved of the individual assets of the portfolio. So this is which property? This is the subadditivity property of your risk measure. Okay, so coherent risk measures, when we have seen that any risk measure to be coherent, it should have 4 properties. One amongst that is subadditivity. Okay, now what does subadditivity says? Subadditivity says that the risk of portfolio, the risk of portfolio is almost, at most means what? At most means what? Maximum, equal to risk of the assets within the portfolio. Okay, X and Y are the components of the portfolio. So the risks involved in the individual assets is always more than or maximum equal to the risk of the diversified portfolio. Okay, yes, further, subadditivity is the most important property of a coherent risk measure. It states that portfolios will have equal or less risk than the sum of the individual portfolios. Understanding? I repeat, it states that portfolios X plus Y, diversified portfolio, will have equal to, we have seen, equal to or less than the sum of individual portfolios. So this is all about subadditivity property. Now let's go ahead to the next property, that is homogeneity property. Now let us understand what does this property say. This property deals with size of portfolio and risk involved in that portfolio. Okay, what does homogeneity property says? That homogeneity means if size of the portfolio is increased by 2 times, then the risk involved also increases by 2 times. If the size of the portfolio is increased by 10 times, then the risk involved, the size of the risk also will increase by 10 times. That is, the size of the portfolio and the risk involved in the portfolio are directly proportional to each other. Now again, let us understand this with the help of an example. Okay, say here stocks involved are X and Y. Okay, say the size of X, the investment in X is, just 1 minute. Yes, stocks X and Y. Okay, the size of the investment in X is how much? Say 1 million. In Y is how much? 1 million. Okay, how much is the risk involved? Here, say 5 million, and here also 5 million. So what is the total investment? 2 millions. What is the total risk involved? 10 millions. Okay, now say this is 1T. Okay, now we have decided to double the size of the portfolio. So investment becomes how much? So here investment becomes how much? 1 million ka 2 million ho jayega, double ho jayega, and here double ho jayega. So what is the risk involved if we double the portfolio? Now अगर 1 million इन्वेस्टमेंट में रिस्क 5 millions है, तो 2 million इन्वेस्टमेंट में क्या रिस्क 5 million रहेगा? तो लोग क्यों ज्यादा इन्वेस्ट करने के लिए जाएंगे? Right? So now the risk also will be scaled up, right? So risk will become how much? 10 millions and 10 millions. Okay, how much is it? 10 millions. So this has become 4 millions and this has become 20 millions. Okay, now let us understand and correlate size of the portfolio and the risk. Okay, now when size of the portfolio was 2 million, it scaled up to 4 million. That is, it became how many times? 2 times. Then earlier the risk was how much? 10 million. This risk became how much? 20 millions. So this has increased by how many times? 2 times. That means if risk is increased by 2 times, the size of the portfolio is increased by 2 times, then the risk involved in the portfolio is also increased by 2 times. So can I say that this is equal? Yes, this is equal. So that means if investment is X, then risk is how much? Rho X. Okay, risk is how much? Rho X. Now, if we double the investment, 2x. Then tell me how much will be the risk involved here? 2 times of risk will be there, right? So let us derive the formula, right? Say number of times is t. Okay, in that case, what will be the formula? Therefore, if x is the total investment and this investment is increased by t times, if this investment, just 1 minute. Yes, if investment, therefore, if say investment is x and this investment is increased by t times, okay, then rho of tx. Okay, how much is the risk involved here? Risk involved is rho x. Okay, so in that case, the scale, the scale by which the size of the portfolio is increased by the same proportion, the risk involved will also be increased. Now here, size of portfolio is increased by t, so here risk will also increase by t. This is nothing but the formula of homogeneity property. So what does homogeneity property says? That size of the risk and size of the portfolio and the risk involved in the portfolio are directly proportional to each other. If you increase the size of portfolio by t times, then the risk involved will also be increased by t times. Okay, so once again, say size of the portfolio is x. Okay, this portfolio is increased by t times. Okay, then the risk involved in x will also increase by t times. Understanding? This is told by homogeneity property. Okay, yes, let's go ahead and see what a homogeneity property has to say. The size of the portfolio t will impact the size of its risk. Okay, if x portfolio is increased by t times, then the risk involved, this is nothing but the risk, rho x, right? This also will be increased by t times. Okay, so this is what homogeneity property says. Further, homogeneity says risk of a position is always proportional to its size. How much? What is the proportion? Directly proportional to the size. So okay, so size of position and risk of position are directly proportional. So this is told by homogeneity property. So till now, how many properties have we seen? 2: subadditivity and homogeneity. Subadditivity, what does it say? That risk involved in the diversified portfolio is always what? Less than or to the max equal to the risk involved of the risk of the individual assets involved in the portfolio. Homogeneity, what does homogeneity says? That size of portfolio and risk of the portfolio are directly proportional. If size is increased by t times, then the risk involved in the portfolio will also increase by t times. Okay, so this is all about homogeneity property. Now let's go to the next property, that is monotonicity property. Very interesting. Now what does monotonicity property says? See, it says that, say for example, we have two positions into consideration, x and y. Okay, say for example, risk of x is more than risk of y. That is, risk of x is more than risk of y. Then in that case, returns of x will always be less than return of y. What does this mean? That if a portfolio, if one stock has better returns than another stock, I repeat, if one stock has better returns than another stock, here tell me which stock has better returns, x or y? When we speak of returns, which stock has better returns? Y has better returns. If one stock has better returns than another, then that stock is at a better risk position. I repeat, that stock is at a better risk position. Now, better risk position. What is meant by better risk position? If you are an investor, from an investor point of view, better risk position means low risk. That means if returns of that particular stock are higher than the another stock, then the risk involved in that stock will be lower than the risk involved in other stock. Okay, so अगर y से here the returns कहाँ से ज़्यादा आ रहे हैं, y, right? Investment in y are giving you is giving you better returns, but risk involved किसमें ज़्यादा है, x में risk ज़्यादा है. So जिससे returns ज़्यादा होंगे उससे risk कम होगा. This is what is said by the monotonicity property. Okay, now let us understand this again with the help of a practical example. Okay, now we are considering two stocks here. Which are they? X and Y. Okay, say expected returns 4%, 8%. Say risk involved, standard deviation. X का है 30%, Y का है 30%. Now, from this scenario, a rational investor will decide to invest in which stock? You tell me. स्टैंडर्ड डिविएशन दोनों का 30% है, मतलब रिस्क इन्वॉल्व दोनों का सेम है. अगर रिस्क इन्वॉल्व सेम है तो देन नेक्स्ट पैरामीटर वी विल चेक विद द रिटर्न्स. किसका रिटर्न ज्यादा है? Y का रिटर्न 8% है, X का रिटर्न 4% है. Right? So that particular investor will choose which stock to invest, will always choose X to invest. Okay? Yes. Now, say standard deviation. Okay, standard deviation is giving you equal risk. Okay, so now the investor has decided to employ one more risk measure. So say that investor has employed VAR as a risk measure. Okay, VAR as a risk measure. Tell me what is the formula of VAR? We have already seen this. Tell me, what is the formula of VAR? VAR is nothing but mu minus Z into standard deviation. Okay, say we are calculating VAR here at 95% confidence level. Okay, so let's do it. Okay, here mu means what? Expected return. So how much is the expected return for X? 4%. So 4 minus. Now tell me, what is the value of Z at 95% confidence level? Come on, quickly, recall. What is the Z? What is the value of Z at 95% confidence level? Yes, is it 1.65? Yes. So 1.65 into 0.3. Okay, this is the calculation for X. For Y, how much is the return? 8. What is the value of Z at 95% confidence level? 1.65. What is the standard deviation? 0.3. So tell me, how much is the calculation of VAR of X? Come on, tell me, what is the VAR of X? Quickly, calculate. I want you to do it practically. Yes. So how much is the VAR of X? Is it 45.5%? Yes. Now VAR of Z. VAR of Y. Come on, calculate VAR of Y. How much is VAR of Y? Is it 41.5%? Yes. So now, if we consider VAR as a risk measure and if we compare the returns, now we have to identify whether to invest in stock X or whether to invest in stock Y. Now, how much is, while considering VAR, which stock has higher risk, X or Y? Come on, VAR of X is 45.5%, VAR of Y is 41.5%. Okay, so risk involved in X is higher. So risk parameters, X is higher than Y. Let me just write it in a better way. Yes, risk involved in X is more than risk involved in Y. Okay. Now from the returns point of view, tell me, X का return ज़्यादा है कि Y का return ज़्यादा है? Y का return ज़्यादा है. Okay, so returns point of view. Okay, return of X is lower than return of Y. Okay, so what does it say? That if return from a particular stock is more than that of the another stock, then the risk is also at a better position. That means better returns, better risk. Better risk means risk is low from the investor point of view. Here, better returns is given by which stock, X or Y? Better returns is given by stock Y. Okay, so risk in stock will be better or worse? It will be better. That means risk involved will be lower. In which stock? Y. Better returns, zyada returns, more returns. Okay, in stock Y will give you less risk in stock Y in comparison with stock X. This is told to you by which measure? Monotonicity measure. Okay, so as an investor, you will always prefer investing in Y. Why? Because returns are also higher and risks are also lower. Right? So this is all about monotonicity property. Now, one more thing. Now tell me, X and Y from bank's point of view. Okay, bank has two customers, X and Y. Okay, now on analysis of the viability, the credibility of X and Y, it is found that X as a customer is more riskier than Y. Okay, then capital cushioning will be kept more for X or for Y. For X definitely, अगर जितना ज़्यादा रिस्क हो उतना ज़्यादा अपने को कैपिटल क्वेश्चन रखना पड़ेगा from the bank's point of view, right? So capital cushioning will be more for more riskier investments. Do you understand? Capital requirement will be more for more riskier investments. So what does monotonicity say? Monotonicity says that if a particular stock gives you higher return, then risk involved in that particular stock is better than that of the another stock. Risk is better means risk is lower. Better returns, better risk. Better risk from investor point of view means low risk. That is, better returns gives you low risk. Understanding? So this is what is told to you in the monotonicity property. Let's see the theory. It says portfolio with greater future returns will likely have less risk. So say these are nothing but returns and this is nothing but risk involved, right? Rho is nothing but a risk measure, right? So if returns, here returns kiske zyada hai, X ke ki Y ke? Y has better returns. So risk kiski better hai? Better risk means low risk. Come on, tell me who has low risk? Y. So ideally, in which stock you should invest? In Y. Understanding? Further, monotonicity suggests that if one risk always has greater losses. Greater losses means what? Risk is higher. Okay, so here in whose case? X or Y? Whose case risk is higher? X. Okay, the capital requirements should be greater. So in case of X, in a case of customer X, capital cushioning should be greater. Okay, so this is all about monotonicity property. So till now we have seen three properties: subadditivity, homogeneity, and we have seen about monotonicity. Okay, what does subadditivity says? That the risk involved in the portfolio is always less than or equal to the risk involved in the individual assets of the portfolio, right? What does homogeneity says? That size of risk and size of position and risk of position are directly proportional to each other. Now what does monotonicity says? Monotonicity says that better returns, stock which gives you better returns, okay, stock which gives you better returns will have better risk involved, that is lower risk involved. Okay, now let's go to the last coherent risk measure, that is the risk-free condition. Now this is very interesting. Okay, risk-free condition is also known as translation invariance. Okay, it is also known as translation invariance. Now, translation invariance. Now, say you have a portfolio. Okay, in that portfolio, say you have invested in X, you have invested in Y, and also you have cash portion involved. Okay, now risk of portfolio will be what? Risk of X plus risk of Y plus risk of cash. Any doubts here? No, nothing to be doubtful about. It's a very common sense thing, right? So let us write this in a symbolical view. Risk of portfolio will be risk of X plus risk of Y plus risk of cash. Now tell me one thing, my dear students. Does cash portion ever have any risk attached to it? No. Cash is always risk free. Okay. So if I say that risky situation is 1, then non-risky situation or risk-free situation will be what? -1. Yes or no? I repeat, if risky situation is 1, then non-risky situation or a risk-free situation will be opposite, that is -1. Now, cash. Tell me, in terms of cash, is it a risky asset or a risk-free asset? It is a risk-free asset. Means no risk is involved, right? So here, while considering the risk of cash, first thing that I'm going to write is the minus sign. Why? Because cash is absolutely a risk-free asset. There is no risk at all involved in terms of cash. There is no risk involved in terms of cash. Okay? Okay? So here, while writing the risk of cash, first thing I've written is negative sign. Why? Because risk-free asset, no risk involved. Understood. Now, in case of cash, say if I have 1 lakh rupees, okay, if investor has 1 lakh rupees, can entire 1 lakh be used in order to reduce risk or in order to create a liquidity situation? Yes, पूरा के पूरा 1 लाख आप इस्तेमाल कर सकते हो in case of cash. So how much is the risk-free portion of cash? 100%. Right? So here, risk involved in cash is always negative. Why? Because it is risk-free. There is no risk involved only. Right? And how much is the risk-free portion? 100%. Right? So therefore, can I say that risk of portfolio will be nothing but risk of X plus risk of Y plus and minus becomes minus cash. Okay, so when cash portion is involved in the portfolio, that cash portion goes to reduce the risk of that portfolio. This is told to you in the risk-free condition property. So what does risk-free condition property says? That if you have cash as a part of your portfolio, then the risk involved in that portfolio will be reduced. By how much portion? By the cash portion. Why? Because cash is risk free. There is no risk involved. इसलिए हमने यहाँ पे माइनस साइन लिखा है. और कितना रिस्क फ्री होता है? 100%. पूरा की पूरा कैश रिस्क फ्री होता है. इसलिए हमने इधर कैश लिख दिया. So plus and minus becomes minus and the cash portion. So risk of portfolio is reduced by the cash portion. Okay, let us understand this with the help of a practical example for better understanding. Yes, let's go ahead. Say situation 1. Yes. Okay. Say you have a risk. You have capital, risky capital. Then say yes. Say you have risky capital. Then say you have risk-free capital. And now let us understand the total effect of both the components. Situation number 1. Okay, say capital. Risky capital say is 10 lakh rupees. Risk-free capital say is 0. So tell me, how much is the total capital employed here? 10 lakh. Next. Okay. Further. Say risk involved with this capital is 30%. Here 0%. Or nothing at all. Let's not. Oh, I'm sorry. Then tell me. Risky capital here, risk-free capital is how much? Nothing. Okay, so total effect is risk of that entire capital involved. Next, what we are going to consider is capital at risk. Now tell me. Okay, if 10 lakh is my total capital, risky portion is 30%. How much is my capital at risk? 3 lakh. Here, 0. So what is the total effect here? 3 lakh. Okay, this is very simple to understand. Now consider situation 2. Now, under situation 2, capital involved, risky capital is 9 lakhs, risk-free capital is 1 lakh, and therefore my entire capital involved is 10 lakhs. Okay, further. Now, risk. How much is the risk involved here? Say here 30%. Now, in case of risk-free capital, is there any risk involved? No, it is risk-free. There's an opposite situation here. So here, risk will be how much? First, I'm going to write negative mark. Why? Opposite situation है भैया. अगर risk रहा तो 1, अगर risk नहीं रहा तो opposite -1. Right? So here, risk involved is minus. And how much is your risk-free portion? 100%. So risk-free capital here is cash. Then in that case, how much is your risk-free portion? Pura ki pura 100%. So your risk involved will be how much? -100%. Okay. So now let us calculate how much is the total capital at risk. Okay. Risky capital 9 lakh. Risky portion 30%. So that goes to 2,70,000. Here. 1 lakh is my risk-free capital. Here risk involved is -100%. Risk-free है भैया, पूरा की पूरा opposite situation है, इसलिए हमने उधर माइनस लिख दिया. और कितना risk-free है? पूरा की पूरा 100%, 100%. So -100% is the risk involved. So here, how much is the risky capital? -1 lakh. Right? So what will be the total effect? Here 2,70,000 minus 1 lakh, 1,70,000 will be the what? Will be the risk involved here, will be the risky portion of the capital. Net capital at risk will be how much? 1,70,000. So from this example, can you say that the risk of a portfolio is reduced? It is reduced by the cash portion of the cash portion included in the portfolio. Okay, so what does it say? What does risk-free condition says? That when we consider risk of portfolio, say for example, अगर आपका portfolio में X, let's say if X है और cash है, okay, this is your portfolio, then the risk of this portfolio will always be risk of X. Cash portion है, risk-free है, so minus कितना 100% पूरा की पूरा minus cash. Okay, say if cash is nothing but, if cash is say n, in that case what will be the formula? Risk of x plus n is equal to risk of x minus n, where n is equal to what? Cash portion. So now let's go to the formula given by the risk-free condition. It says risk-free condition, the risk of a portfolio is dependent on the assets of the portfolio, right? What are the constituents of the portfolio? And if cash is involved in the portfolio, then the risk of the portfolio is reduced by the cash portion of the portfolio. That is P of x plus n is equal to P of rho of x, not P, sorry, rho of x. Right there, that is the risk involved in x minus the cash portion, because n is nothing but the cash portion. Okay, further, risk-free condition means that there is no additional capital requirement for an additional risk for which there is no uncertainty. Now what happens, capital cushioning is required for the unexpected losses, right? If there is no uncertainty at all, in case of cash, in case of risk-free investment, is there any uncertainty involved? Is there any risk involved? No, it is not involved. So does capital requirement, is additional capital requirement required for that particular risk-free asset? No, it is not required. Unlike we have seen X and Y, which was riskier, X was riskier. So is additional capital cushioning required for X? Yes. But in case of risk-free asset, there is no uncertainty, therefore no additional capital requirement is done for that particular risk-free asset. Okay, so these are the 4 properties which make a risk measure a coherent risk measure. Quickly, let's go through once again all the 4 properties. First is subadditivity. What does subadditivity says? That the risk involved in individual assets is always more than the risk involved in the entire portfolio. At the maximum, it may be equal to. Okay, yes. Further, next, what have we seen? Homogeneity. Size of position and risk of position is always what? Directly proportional. Okay, if the portfolio is increased by t times, in that case the risk involved in the portfolio will also be increased by t times. Then the next is the monotonicity. Monotonicity says that better returns, stock with better returns have better risk. Better risk means low risk. ओके तो रिटर्न अगर ज्यादा है, यहाँ पे y का रिटर्न ज्यादा है, तो किसका रिस्क लेस होगा? y का रिस्क लेस होगा. Okay, and the last that we saw was the risk-free condition, where it is said that the risk of the portfolio depends on the assets of the portfolio. If cash portion is involved, if risk-free asset is involved in the portfolio, then the risk is reduced by that cash portion, where n is what? N is nothing but the cash involved. And the last point for the coherent risk measure, it says that the second, third and fourth, that is homogeneity, monotonicity and a risk-free condition, imply well-behaved distributions. Now, what is meant by well-behaved distributions? We have already seen in detail while we have learned VAR. So this is all about coherent risk measure. Okay, whenever for every particular organization, identifying risk identification is done, and then quantification of risk is done by using an appropriate risk measure. Okay, risk measure selection is very important because the quantified risk, the attributes of the quantified risk depends on the risk measure which is employed in order to quantify that particular risk. Okay, risk measures should be coherent. A coherent risk measure always has 4 properties. Which are they? Subadditivity, homogeneity, monotonicity and risk-free condition. If all these four properties are present, then that particular risk measure is said to be a coherent risk measure. Okay, so this is all about coherent risk measure. Next, we shall continue in the next lecture. Till then, see you and take care.